Welcome to Market Brief, After Hours. Today, we are unpacking a highly volatile Tuesday in the markets. We've got inflation heating up again, oil surging back past that critical $100 mark, and tech stocks feeling the burn. To help break it all down and make sense of the numbers, I'm joined by our resident market analyst. Welcome to the show.
It is great to be here. There is certainly a massive amount of data to digest today, especially with these latest inflation numbers completely shifting the mood on Wall Street.
Let's start right there with the major U.S. indices. It was definitely a mixed bag at the closing bell. How did the big three shake out?
Well, we saw the Dow Jones Industrial Average actually manage to extend its gains, adding just over 56 points, or 0.11%, to close at 49,761. That resilience was mostly thanks to energy-linked and defensive sectors, which really helped offset the broader market weakness.
Right, because the S&P 500 and the Nasdaq definitely didn't share that optimism.
They did not. The S&P 500 slipped 0.16%, finishing at 7,401. It was heavily pressured by rising Treasury yields and that strong rise in oil prices, which weighed down large-cap tech. But the Nasdaq Composite took the heaviest blow, pulling back from its recent record levels. It declined 0.71% to close at 26,088.
And that was largely driven by the semiconductor space, correct?
Exactly. Weakness across semiconductor stocks weighed heavily on the tech-heavy index. For instance, Micron Technology fell 3.6% today. Now, that comes after surging more than 37% last week and roughly 53% over the past month during the memory chip rally. So some of this is a natural pullback. We also saw AMD drop 2% and Qualcomm plunge 11% as traders actively locked in their profits across AI-linked technology shares.
Hanging over all of this price action is that massive inflation report. The numbers were definitely hotter than expected. Walk us through the key takeaways there.
Hotter and much more broad-based than anyone wanted to see. Consumer prices rose 0.6% in April alone. That lifts the annual inflation rate to 3.8%, which is above expectations and the highest reading we've seen since May 2023. Meanwhile, core inflation increased 2.8% annually.
It feels like everywhere you look, household costs are climbing sharply. Housing, groceries, services, it is all going up.
The data absolutely backs up that feeling. Shelter inflation climbed 0.6% during the month and 3.3% year-on-year as housing-related costs continued rising. But the food inflation numbers are where it gets really staggering. Food inflation accelerated sharply, with tomatoes surging 39.7%, coffee prices jumping 18.5%, and uncooked ground beef rising 14.5% annually.
Almost 40% for tomatoes? That is the kind of inflation consumers feel immediately at the checkout line.
It really is. And it's not just physical goods. Services inflation also remained elevated. Lodging away from home rose 4.6%, and delivery services increased 13.6% over the past year. It really highlights the broadening pressure across all categories of household spending.
And we can't talk about inflation without talking about energy. Oil is back above $100 a barrel. Energy prices remain a major inflation driver. What is the catalyst for this latest spike?
A lot of it comes down to fading optimism around the U.S.-Iran negotiations. Oil prices rallied sharply after hopes for a breakthrough deteriorated further. President Donald Trump rejected Iran's latest counterproposal and warned the ceasefire was on massive life support. That immediately increased fears of prolonged disruption around the Strait of Hormuz. As a result, West Texas Intermediate crude jumped 4.19% to settle at $102.18 per barrel, while Brent crude rose 3.42% to close at $107.77.
Which brings us to the bond market. How were Treasury yields reacting to this combination of sticky inflation and surging oil?
They are climbing right alongside those inflation expectations. Following the hottest CPI reading since 2023, the benchmark 10-year Treasury yield rose more than 4 basis points to 4.459%. The 2-year Treasury yield climbed to 3.989%. We even saw the 30-year Treasury bond yield push above 5% to 5.023% as investors rapidly reduced their expectations for any near-term Federal Reserve rate cuts.
Before we head to a break, did this inflation anxiety spill over into the Asian markets?
It did, creating a very mixed session. Japan's Nikkei 225 actually rose 0.52%, and the Topix gained 0.83%. But that happened while Japan's 10-year government bond yield climbed to 2.545%, its highest level since 1997. In China, the Shanghai Composite slipped 0.25%. South Korea's KOSPI 100 dropped 2.28% after concerns emerged around possible taxes tied to AI-related profits. Australia's ASX 200 declined 0.36%, and India also weakened, with the BSE Sensex falling 1.92% as their own retail inflation quickened to 3.48%.
It is truly a global ripple effect. We are going to take a quick break, but when we come back, we will look at how European markets are handling this pressure, dive into the latest Forex technicals, and highlight today's biggest individual market movers. Stay with us. Welcome back to Market Brief, After Hours. Before the break, we covered the U.S. inflation shock and the mixed bag in Asia. Let's shift our focus to Europe. It sounds like they had a pretty rough day across the board.
They certainly did. European equities closed broadly lower, with the stock 600 falling almost 1.1%. Investors there are reacting to the exact same global headwinds, higher oil prices and accelerating inflation, but they are also dealing with growing political uncertainty in the UK.
Let's break down the specific European market countries. How did the major indices perform?
Germany's DAX took a significant hit, dropping 1.62%. This comes as Germany's annual inflation rate accelerated to 2.9% in April, largely driven by a massive 10.1% jump in energy prices. Italy's FTSE MIB lost 1.36%, and France's CAC 40 declined 0.95%.
You mentioned political uncertainty in the UK. What is developing there, and how did their market react?
The UK's FTSE 100 slipped 0.22%. Political pressures really intensifying there after more than 100 Labour lawmakers called for Prime Minister Keir Starmer to resign, or at least outline a departure timetable, following the party's weak local election performance. Pair that with UK retail sales unexpectedly contracting 3.4% year-over-year, which is the first decline since November 2024, and you have a very jittery environment.
It seems like inflation is the dominant theme everywhere, though I understand Switzerland is an outlier right now.
Yes, Switzerland is going in the complete opposite direction. They just extended a near 3-year deflationary trend, with producer and import prices actually falling 2.0% annually. It's a fascinating contrast to the rest of the continent.
That is a stark difference. Let's pivot over to the currency markets. There was a lot of technical movement today. Let's start with the euro versus the dollar.
Euro USD pulled back towards some key moving average support today. It closed at 1.1743, down 0.34%. It tried to push above the 1.1800 handle, but failed. However, price continues to hold above the 100-day simple moving average at 1.1710, the 200-day SMA at 1.1682, and the 50-day SMA at 1.1645. The latest move reflects fading short-term momentum, with immediate resistance remains at 1.1788.
And what about the British pound? Did that political turmoil drag it down?
It definitely came under pressure. GBP USD reversed lower after failing near the 1.3600 region, finishing at 1.3542, down 0.50%. Although it dropped, the pair remains positioned above the 100-day SMA at 1.3483, the 50-day SMA at 1.3428, and the 200-day SMA at 1.3424. Resistance is now located at 1.3614.
Did the rising Treasury yields give the dollar an edge against the Swiss franc and the yen?
Yes, it did. USD CHF rebounded modestly, rising 0.35% to close at 0.7806. But the broader downtrend remains intact because it continues to trade below the 100-day SMA at 0.7841, the 50-day SMA at 0.7861, and the 200-day SMA at 0.7922. USD JPY, on the other hand, edged higher to 157.58, up 0.28%. It found support from those rising U.S. yields and managed to hold above the 100-day SMA at 157.35 and the 200-day SMA at 154.30.
Before we leave the technicals, where did gold end up?
Gold struggled near a key moving average cluster today. It closed at $4,714, down 0.40%. Bullion failed to sustain its intraday gains and continues trading below the 50-day SMA at $4,758 and the 100-day SMA at $4,777.
It is, however, remaining comfortably above the 200-day SMA at $4,303.
All right, let's wrap up today's brief with the big individual market movers. Who were the standout winners and losers?
On the winning side, Vestas had a massive day. Shares jumped more than 29% after the uniform and apparel company reported stronger than expected fiscal second quarter results and raised its fiscal 2026 EBITDA guidance. Wendy's also had a fantastic session, climbing more than 16%.
What was the catalyst for Wendy's?
Takeover speculation. Reports suggested Nelson Peltz Tryon Fund Management was exploring financing options for a potential bid to take the company private, and the market clearly loved that idea.
That is definitely one to keep on the radar. What about the downside? Who took a hit today?
Zoom Info Technologies took a brutal hit, plunging 32% after they lowered their full-year revenue forecast to between $1.185 billion and $1.205 billion, which was well below their prior outlook. And Under Armour dropped 17% after reporting a larger-than-expected fiscal fourth-quarter loss and revenue of $1.17 billion, completely missing analyst expectations.
A lot of moving parts today, from a 3.8% inflation rate to oil breaking $100 and some massive individual stock swings. Attention will definitely turn toward upcoming U.S. economic data to see if these persistent inflation pressures feed more aggressively into consumer spending. Thank you for breaking it all down for us today.
My pleasure. There is always a lot to uncover when the data shifts this dramatically.
And thank you to everyone listening. If you find this useful, please follow Market Brief After Hours.